Hello, everyone, and welcome back to your daily English dose. It's fantastic to have you here today. Have you ever thought about investing your money to make it grow, but felt overwhelmed by all the complex terms and concepts, especially in English? You're definitely not alone. Investment can seem intimidating, but understanding its basics is crucial for building a secure financial future. Today, we're going to break down the world of investment into simple, understandable pieces, focusing on key English vocabulary you need to know as a beginner. This isn't just about learning English. It's about empowering you with the knowledge to make smarter financial decisions. We'll cover what investment is, why it's important, and the fundamental types of investments, all while focusing on clear, practical English. Get ready to invest in your financial future and your English skills simultaneously. Let's dive in. Our second common investment type is bonds. A bond is essentially a loan you make to a government or a company. When you buy a bond, you're lending them money, and in return, they promise to pay you back the original amount, the principal, on a specific date, the maturity date, plus regular interest payments. Bonds are generally considered less risky than stocks because you typically know exactly how much interest you'll receive and when your principal will be returned. They are often seen as a safer, more stable investment, especially for people with lower risk tolerance. For example, if you buy a $1,000 government bond with a 3% annual interest rate, you'll receive $30 in interest each year until the bond matures, at which point you get your $1,000 back. The trade-off for lower risk is usually lower potential returns compared to stocks. Moving on to mutual funds. A mutual fund is the type of investment that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Think of it as a professional money manager investing on your behalf. When you invest in a mutual fund, you don't own individual stocks or bonds directly. Instead, you own shares of the fund. Mutual funds offer diversification, which means spreading your investments across various assets to reduce risk. If one stock performs poorly, others in the fund might perform well, balancing out the losses. They are managed by professional fund managers who make investment decisions. You typically pay a small fee for this management. Mutual funds are great for beginners because they provide instant diversification and professional management without you having to pick individual stocks or bonds. Another popular investment is exchange-traded funds, or ETFs. ETFs are similar to mutual funds in that they hold a basket of underlying investments, like stocks or bonds, providing diversification. However, there's a key difference. ETFs trade on stock exchanges, like individual stocks throughout the day. You can buy and sell them just like you would a stock. Mutual funds, on the other hand, are typically bought and sold once a day after the market closes, based on their net asset value. ETFs often have lower management fees than mutual funds and offer more flexibility in trading. For example, you can buy an ETF that tracks the performance of a specific index, like the S&P 500, giving you exposure to 500 large U.S. companies in one single investment. They are a very popular choice for many investors due to their low cost and ease of trading. Let's talk about the power of compound interest. This is often called the eighth wonder of the world by some financial experts. Compound interest is simply interest earned on interest. Instead of just earning interest on your initial investment, you earn interest on both your original investment and the accumulated interest from previous periods. This creates an exponential growth effect. For example, if you invest $1,000 at a 5% annual interest rate, after 1 year you have $1,050. In the second year, you earn 5% interest on $1,050, not just $1,000. This might seem small at first, but over long periods, the effects are truly astonishing. The earlier you start investing, the more time compound interest has to work its magic. This concept is fundamental to long-term wealth building. Understanding your investment horizon is also important. Your investment horizon is the length of time you plan to hold an investment before you need the money back. Are you investing for a short-term goal, like buying a car in 2 years? Or a long-term goal, like retirement in 30 years? Generally, a longer investment horizon allows you to take on more risk, as you have more time to recover from market fluctuations. Short-term goals typically require lower-risk investments. For example, if you need money in a year, putting it all into a volatile stock could be risky. But if you don't need it for 20 years, a stock market dip is less concerning as you have time for it to recover. When starting, you'll often hear about diversification. We mentioned it with mutual funds, but it applies to all investments. Diversification means spreading your investments across various asset classes, industries, and geographies to reduce overall risk. The idea is simple. Don't put all your eggs in one basket. If one investment performs poorly, others might perform well, balancing out your overall portfolio. For example, instead of investing all your money in just one company's stock, you might invest in stocks from different industries: tech, healthcare, finance, different types of assets, stocks, bonds, real estate, and different countries. This strategy helps protect your portfolio from significant losses if a particular sector or asset class struggles. Another key term is portfolio. Your portfolio is simply the collection of all your investments. It's like your personal investment basket. It could include stocks, bonds, mutual funds, real estate, and more. Building a well-diversified portfolio that aligns with your risk tolerance and investment horizon is one of the main goals of smart investing. You might hear people talk about managing their portfolio, which means actively making decisions about what to buy, sell, or hold to achieve their financial goals. Regularly reviewing and rebalancing your portfolio to ensure it still meets your objectives is a critical part of the investment process. Finally, let's touch upon the importance of financial goals. Before you even start investing, it's vital to define your financial goals. Are you saving for a down payment on a house, your child's education, retirement, or something else? Having clear, specific financial goals will help you determine your investment horizon, risk tolerance, and the types of investments that are most suitable for you. For example, a goal of retirement in 30 years is very different from buy a new car next year in terms of investment strategy. Clearly defined goals give purpose and direction to your investment journey. They help you stay motivated and make informed decisions along the way. Wow! We've covered a lot of ground today. From understanding what investment means to exploring stocks, bonds, mutual funds, the power of compound interest, and the importance of diversification, you've now got a solid foundation in the basic concepts and key English vocabulary of investing. Remember, learning these terms is just the first step. The real power comes from continuous learning and applying this knowledge. Investing can be a powerful tool to build wealth over time, but it requires patience, research, and a clear understanding of the risks involved. Always do your own research or consult a financial advisor before making any investment decisions. So, what was the most surprising or useful term you learned today? Are you feeling more confident about exploring the world of investment in English? Share your thoughts and any questions you have in the comment section below. We'd love to hear from you. If you found this video helpful and empowering, please give it a big thumbs up and share it with anyone who wants to learn about investing in English. And if you haven't already, make sure you subscribe to your daily English dose for more amazing English lessons that empower your life. Hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one. Happy investing and happy learning.